Guys, one of the biggest questions on people's minds is what's going to happen with those rates, man. Today, we've got the man, the myth, the legend, the expert, Nate Jomaa, in here to give you his prediction on the next 90 days.
You better get fired up.
My guy, how you doing?
Hey, I'm good. Good. It's Friday. It's the beginning of what I like to call a great week. The middle of June is a great week. So, let's go.
Let's go, baby. Let's go. You're speaking my language. So we had for several years decreasing rates going all the way down to, well, I'll tell you, my mortgage is at 2.25%, but I think I've got some friends who are even in the ones. Have you seen ones?
They were around for sure. 18 months, 24 months ago for sure. Yeah.
And they sat there for years, man. We had rates under, let's say, 5% for many, many years in a row. And if you're maybe 30 years old and you could buy when you're 18, pretty much your whole lifespan of being able to purchase a property has been phenomenal rates.
Yes.
So now we're up into, let's just say, the sixes. Maybe it's a hair over 7. Maybe it's a hair under 6 at times. But we're in the rough 6s, and people are losing their minds saying, oh my gosh, I can't afford a house. I got to wait. I've done several videos saying, hey, if you do the math, I know the rates suck. I know it's not what you wanted, but it's still probably going to make sense to buy over rent. So we've done that video before. But today I want to talk with you about some of the things you're seeing. Now, you're in the field of looking at rates and all the different numbers, everything else. That's one of the things we appreciate about you, is giving our team insight into things that you're the expert on. So tell us, with all that fear of what's going to happen to rates and some people maybe holding back, waiting for rates to come back down, what are you seeing that is telling you rates might change, and where do you think rates are going to go?
Great questions. So I want to start by saying that rates were really, really low, like we talked about, 18 to 24 months ago, because of some things that were happening intentionally within the Fed Reserve. So the Fed Reserve does not impact mortgage rates, but some of the actions that they were taking were impacting mortgage rates. And what they were doing is they were buying mortgage-backed securities or mortgage bonds to make sure that we were keeping rates lower. And they started doing this as a counter to what was going on during COVID, when there was basically an economic slowdown, right? For a period of time, not as much in Florida, but just nationwide, people weren't leaving their houses. Stores weren't open, restaurants weren't open. We basically had an economic shutdown for all intents and purposes for a short period of time. So the Fed did what is called quantitative easing, and that essentially made mortgage rates come down by what they were doing, buying the mortgage-backed securities by the billions of dollars every single day. And this went on for a period of time. And what happened toward the tail end of 2021 was that we saw inflation started to creep up. And the Fed was hot to say that inflation was transitory, and they just kept their quantitative easing. And basically, I'm going to take a quick step back and then come right back to this. When we see inflation numbers trickle up, mortgage rates tend to follow. So those two things aren't directly related, but they do tend to follow suit with one another. So as we saw those inflation numbers start to creep up at the end of 2021, in theory, rates should have continued to trickle up along with inflation. But what happened again is the quantitative easing, they kept those rates down.
Yeah.
And so as inflation continued to creep up, the rates were kind of staying stagnant until the Fed finally said, whoa, hold on. Inflation is transitory and we need to do something. But by that point, we had basically a 90 to 120 day window where they should have stopped it, and we didn't. And so that just widened that gap. It made the delta from where rates were to inflation even wider. So as you recall, last year in 2022, we, over a very short period of time, saw rates quickly climb. And that was only because they were getting to where they would have been anyhow, right? So we went from what would have been a very slow stair step up to, over the course of a 30 to 60 day window, rates just went, okay. So now we're in a period of time where inflation is starting to ease a little bit, but rates haven't caught up yet because of some other economic factors that were going on earlier this year and presently. So there's two things I want to touch on, and then I'll talk about what I expect to happen over the course of the summer here. The first thing being, earlier this year, we had a debt ceiling scare. And basically, to break that down for anybody that doesn't understand what that means in terms of economics, we all have a personal debt ceiling. We can't take on any more debt than X or Y based on credit cards, income, whatever the case might be. So I'll use a real world example. Let's say, Joe, that I have a credit card that has a balance of, a credit line of $1,000. My balance can't exceed $1,000. That's my debt ceiling on the credit card, right? If they give me $1,000 to use, I can't use more than the $1,000 they gave me.
Yep.
Well, in the US, we have, for all intents and purposes, a very similar situation where we've borrowed money and we have so much credit available to us, and we were getting to the top of that. So we were hitting the debt ceiling, and there was concern about what do we do? How do we either pay off the debt that we have, the national debt, or how do we acquire additional credit? So they solved for that. I'm not going to get into the deep. That's a completely different conversation we can have another day. But they did solve for that. But during that period of time, there were some concerns, and a lot of people were tightening their purse strings, including the big banks. Then, along with these big banks that were tightening their purses, we had these smaller banks, such as Silicon Valley Bank, that was just doing some really bad things economically and financially, and they went under. And then a series of other smaller regional banks followed suit, not because of that, but related to that. There was a lot of stuff going on. Okay, so that really did not help mortgage rates because there was a lot of scarcity in the financial markets, in the economic markets, of what's going on, what is happening. So that was happening. And then the other thing that really ties into this and helps to keep rates where they have been over the last 6 months here in 2023, when I go to the bank, when you go to the bank and you deposit money with them, let's say that you deposit $10,000 with them, they're not going to just sit on your $10,000. They're going to keep some of that aside so that you can go in and get it out if you need to. But the banks make money by loaning that money back out. So they loan it out in credit cards, car loans, boat loans, personal loans, whatever you want to call it. That's how they make their money. They make money on the interest. All right. So what happened recently, because of the fact that we had higher prime rates are higher now than they've been, probably 20, 30 years, right?
What's the prime rate?
What is the prime rate?
What is a prime rate?
So prime rate is the it's hard to explain it without really getting into the mud. I want to keep it for everybody. The prime rate is the rate that is set by the government. It's called the Wall Street Journal prime rate. And that rate kind of drives a lot of other things. It drives what goes on with a lot of things. A lot of things are tied to the prime rate.
I just want everybody to know that's kind of a base rate, I guess, is what I would call it. And a lot of other things are prime plus this. Your credit card might be prime plus that.
Exactly.
You know, that's a government-based base rate. Okay.
Yes. Thank you for helping me make it easier for other people to digest. So prime has been higher. So there's a lot of people now that aren't taking out loans because rates are just higher across the board. Yep. A car loan now costs considerably more today than it did 24 months ago. Same car, same cost. I'm going to buy, the Joe Rosen, XYZ, and it cost $60,000 2 years ago. Well, let's say it still costs $60,000. The payment is going to be $1,000 more because the rate's higher.
Yep.
Right. So there's a lot of things going on. So the banks aren't able to attract as many buyers for these offshoot loans that they do, car loans, boat loans, things like that. So the way that they remain liquid is they borrow money from the Federal Reserve and they sell off assets that they have. They're selling off mortgage-backed securities. They're selling off treasury. So those things are not helping rates come down right now. So these are things that are currently happening, the debt ceiling, and then banks basically just trying to make sure they're not getting a run on money, making sure they're remaining liquid. Because what happens, there was a movie, the Christmas movie, right, where the guy has the bank and everybody comes and gets their money and everybody's freaking out. I'm sure we all know what I'm talking about.
Yep.
Banks are avoiding that now by doing this to remain liquid. So there's these two factors that are kind of working right now against where mortgage rates are. Good news is we solved for the debt ceiling, and we're starting to see, as I said, inflation start to come back down again, and there's a little bit more trust in the system now. So we should see a little bit of some easing with rates over the next couple of months. There's a lot of factors. I could go on for probably an hour breaking it down and getting into the nitty gritty. If somebody wants to get into the weeds with me on it, please get in touch. Let's do it. We don't have time on the show to do it, but there's a lot of stuff going on.
So can you share with us roughly where rates are now? And when you say you believe there's a better chance they'll come down than that they'll go up, how much are you talking about? Because I know people want specific numbers.
Yeah. So depending on your qualifications and the type of loan that we're looking at, you could see rates anywhere from the 6s up to the 7s.
Right now,
rates are going to be somewhere in the 6s, somewhere in the 7s, depending on your unique qualifications and the type of loan you're going for, and many, many data points. So when I say that I think rates are going to improve, I mean that we might see 0.25% to the rate, 0.5% to the rate. I can tell you, Joe, that there's a very, very, very slim chance that we're ever going to see rates in the 1s, 2s, 3s again in our lifetime. We will see rates come down into the 5s again. We could even see rates come down into the 4s at some point. That's definitely not going to be in the next 90 days, but we could see that at some point. But right now, we're going to see probably 0.25% to 0.5% rate decrease over the course of the next 90 days. Now, somebody might say, well, why would I want to buy a house and lock right now if I can wait 90 days and get a better rate? I want to remind everybody that the longer you wait, the more expensive that house is. So the little bit of rate savings that you're getting by waiting is going to be completely wiped out by the cost of what that house now costs.
Yeah, I would also add that you can do a buy down. If rates do go down, you can refinance. And to your point, Nate, as soon as rates do come down, it's not just, hey, I'm getting a sweet deal. All of a sudden, because people don't come to you and say, hey, I want to get approved for 400 grand.
Right.
They've done the math and they know what a rough payment is on 400 grand at what they assume will be their interest rate.
Sure.
And how many times do you say, great, you're approved for 400 grand. And then you tell them the payment and they're like, no, I can afford a little bit more. Or, no, that's too much. I actually need to come a little bit lower.
Yeah.
It happens all the time, right? So they're not really, most people, in my opinion, and Nate, I think you'd agree, they don't care if they're paying 400 grand or 800 grand for a house. They care what their monthly payment is. So as soon as those rates come down and you're able to afford more house, everybody can afford more house. Everybody's going to rush out and prices are going to come up. We saw it, right? So I agree with you 100%. If you think that your strategy is going to be wait for rates to come down, you're just going to get bit in the butt by a higher price, right? And you can always refinance if that's what happens.
Yeah.
And like I said, you can do a rate buy down where you pay some money up front, or maybe you negotiate the seller to pay some money up front, and you can reduce your rate. Either short term, they got things called a 2-1 buy down. You can do a bunch of different buy downs, or something over the life of the loan. Guys, whether you're watching on Facebook or YouTube, number one, I appreciate you. Thank you so much. I hope you're enjoying this. Number two, please put your comments in while we're live, and I'll absolutely share them with Nate, and we'll get you some expert answers here. I do have a question for you. Yesterday, I think it was yesterday, maybe the day before, the Fed had come out with some interesting news. It was all over the headlines. What is your opinion on what was said? And maybe start with what was said.
Put me on the spot a little bit, Joe, because yesterday I was out of pocket a little bit. So I'm not exactly sure what specifically that you're referring to.
Let me look it up here.
Sure. While you're doing that, I'll say the other thing to consider, if you're one of those that says, well, 90 days from now, rates are going to look better, I'm going to wait. Everybody else has the same mentality. And if we go back 18 to 24 months, everybody that's sitting on the sidelines with you waiting for rates to get better is going to jump back in. Yeah. And Joe can tell you 18 to 24 months ago, we had bidding wars, right? So if you think you're buying a house for $400,000, that might be what it's listed for. But for you to win the offer, you're going to have to bid above and beyond that. So not only is that house going to sell for more today, or rather 3 months from now, than it will today, but you're going to have to pay more to buy the house if you want it. So all of the rate savings that you think you're going to get waiting are going to be completely wiped out, if not in the other direction, if you wait long enough. That's just going to happen. It's a reality.
So I was hoping to find something a little bit better, but I will say, so the Fed Chair Powell came out, and everything I had read, take what I say with a grain of salt, had
Sure.
said that, hey, we're not going to raise rates right now, but
Yes.
this year, before the end of the year, we do plan on raising rates. They did say that they had seen inflation plateau, maybe even come back a little bit. And I'm sorry for putting you on the spot.
Oh,
I
it's
just
okay. I know what you're talking about now. Yeah. So they had
okay.
the Fed meeting Wednesday, and they did mention that they were pausing, raising the Fed fund rate at this point, which is fantastic. But again, the Fed fund rate is not translated directly to mortgage rates, right? So the Fed fund rate is the rate that banks borrow money from the Federal Reserve. So they take the money out of rate, and then they translate that into where they set their price point for consumer goods. So those are short-term buys. Those are for credit cards. Those are for car loans, right? So I know that they're making the mortgages. I know that they're making the loan periods on car loans longer and longer now to try to keep the prices down. But a car loan is still a short-term loan. A mortgage loan is a long-term loan. You're making 360 payments. That's 30 years. So those things aren't tied together. But yeah, it's great news that they're saying that. They are also in a mode of CYA because they want to make sure that they don't say we're going to halt or this is happening or that's happening without also throwing in, oh, by the way, we reserve the right to raise rates later this year.
Yeah.
It's really going to depend.
I'd love a lender's perspective on this. We thought as an industry, maybe you thought this too, I certainly thought this, that as rates came up, which we knew eventually would happen, we thought prices would come down. It just, made sense that, hey, if I can afford X amount a month, that means that if rates come up, then what I can afford in payment not in payment, in price will come down. So prices will have to come down. But what we've seen is, while that's true, and while I think that would have happened in any other market, in this market, people have such phenomenal rates, right? They're in the 1s, 2s, 3s, even the 4s. They don't want to give that up unless there's something critical like a job change, a divorce, a death. They're not moving just for fun. Whereas a couple years ago, they'd say, hey, I made 100 grand, 200 grand on my house over the span of a couple years. Let's move. And they would just move to move because there was so much money flowing around. You could do it.
Yeah.
Now I'm seeing a lot of sellers say, Joe, we're very happy with our 2.75% interest rate. If we were to go out and buy, it's going to be 6-7%. We're just going to hold tight. That tightness from a seller's perspective has dropped the supply, which means that even if the demand has dropped a little bit, it doesn't have an impact on prices. And I would say that's even more true in Florida than a lot of other states, just because we have such an influx. I think it's 800-900. It used to be 1,000, 800-900 a day of new residents flooding into our state from other states for a myriad of reasons. So from your point of view, from a numeric analytical point of view, do you have any thoughts on that phenomenon we're seeing?
Yeah. So without getting really deep into the weeds, which we can do offline because it's a very long conversation. The short answer is to your point, there is a tremendous amount of demand now to buy and not enough supply, which is the opposite of what we saw back in 2007, 2008. There was a tremendous amount of inventory and there was not enough demand. And that's what caused this to happen. And so from that date, if you go back 33 years, there was something that happened in the government that caused housing formations to decrease. Housing formations is when two people get together and become a household. So you and your wife get together, you become a household. Me and my wife get together, we become a household. So 33 years prior to the 07-08 range, there was something that happened in our government that caused housing formations to decrease. So I'm not going to get into the politics of it, but that happened.
You don't want to get into politics?
Not today.
So I just looked at some stats. I watch inventory here in Port St. Lucie all the time, right? I look at single family homes for sale in Port St. Lucie. The peak was around January. This is from memory. It was high 1300s. I'm going to say 1375. But but it was somewhere between 1350 and 1399. And now when I looked last Monday, well, by last Monday, I mean 4 days ago, it was 821. I put that number out in our sales meeting, right? 821. That's a pretty big reduction.
Yeah.
I just looked it up now and we're at 806. So if I do the numbers here, let's just say 1375 minus that 806 divided by the 1375. That's a 41% reduction in the inventory available in Port St. Lucie alone. That's not a small number. A 10% reduction. That's newsworthy. We're talking a 41% reduction. And again, I think what it is, and I'm only speaking from our experience, right, is a lot of people still have, and I remember this from 07, 08. At one point, someone, whether it's Zillow or a realtor or their cousin, it doesn't matter, told them their house was worth X. The price can come down 5, 10 grand. It doesn't have to be a lot. And they're not only asking that original price that's 5, 10 grand more, but they want another 20 grand. That's why they were selling. They want the money. And they're not getting showings. They're getting a frustrated listing agent. And so they say, forget it. Let's take the home off the market, right? So you're seeing inventory continue to drop. Now, I've talked about this several times. In Port St. Lucie, and I think this is probably pretty true around the state of Florida, I'm seeing 2 separate markets. Anything 500 grand and up, it's kind of a neutral market, maybe a light buyer's market. But if you're looking at that first-time home buyer range, which is, in my opinion, kind of 450 and under, we're looking at 5-6 weeks of inventory. That is hot. Those homes are popping, right?
Yeah.
Nate, you see buyers all the time. You probably see more buyers than I do. How often are these buyers coming in the first-time home buyer, let's say 450 and under range, and they're going up against at least one other offer in a multiple offer situation?
It happens a lot. A lot of the agents that I work with, when there's this submission that's made, an offer rather that's made, I reach out to the list agent and try to make sure that I understand what their seller is looking for, so that I can make sure that if it's these 3 things, well, here's how my buyer that's pre-approved with me meets these 3 things. And so, having said that, I talk to many listing agents for the same buyers, because they're not always getting the first one that they look at, because there are multiple people bidding for those houses now. It's not like it was before. It's not as crazy as it's going to get when rates come back down, but there are still a lot more buyers in the market and not enough inventory. So for any single house that you're looking at, 450 and under, there's guaranteed to be multiple qualified, interested parties that are making offers on that property.
So I'm going to end with 2 questions. If I were a buyer and I'm renting, and let's just go apples to apples, whatever my payment is, it doesn't matter. 2,500, 3 grand, 4 grand, whatever, it doesn't matter. If I were a renter and I'm renting and I come to you and I say, hey, listen, my rental agreement is up in 2 to 3 months. Rates are high. I'm thinking about staying for another year, and then I'll consider purchasing based on the rates. What would your recommendation be to me?
My recommendation would be to look at what your cost savings would be if you bought today 10 years from now versus waiting 12 months and doing that same 12 or 120 month period, because you're going to find that you're going to lose a considerable amount of money. And I'll just give you a very quick scenario. When you're renting a house, let's say that it is $3,000, doesn't matter. That $3,000 that you're paying leaves your pocket and never comes back.
Yep.
If I have a mortgage and my mortgage is just say $3,000. No, you know what? For the sake of argument, Joe, my mortgage is $3,500. It's $500 more.
Yep.
Because I'm going to make the point regardless. I'll show you. So I'm paying $500 more for my mortgage. When I make my mortgage payment, where does that money go? I ask people all the time, and they say it goes to the mortgage company. Yes and no. Some of that is going to be interest that you're paid, and that does go to the mortgage company. Some of that is principal that you're taking from your right pocket and putting into your left pocket in terms of paying down the mortgage that you owe. And while you do this for 12 months, let's just say it's a 1-year period. For 12 months, you're making 12 payments. And so for 12 months, you're adding more money into your left pocket from your right pocket. Some goes to interest, some of it goes back into your other pocket. At that same 12-month span, you're also having your home appreciate. We just talked through this. Home prices are continuing to still incline. Not crazy like they were several months ago, but we're still seeing home prices go up, right? So you're losing the amortization, which is you paying down your mortgage, and you're losing the appreciation, which is you gaining equity in your property. So you wait a year from now, that's an entire year of lost appreciation and amortization. And we've done the math before. I've shown you it, depending on the numbers, it's hundreds of thousands of dollars that you've lost.
Yep. Guys, I'm going to pull something up right now just to kind of show you. Nate, can you see it on my screen?
Yeah, I can.
Okay, so this graph down here, you can see you've got a dark blue, light blue, and a green line. What Nate's referring to is when you are paying your landlord, essentially you're paying your landlord's mortgage, you're helping that person pay down this light blue line, okay? And that light blue line is you actually paying down the loan amount. So here I just threw in a number of 500 grand. After a month, maybe they're going to owe 498, right? And after 2 months, it's 496 or whatever it is, right? You can see that this amount goes up and up and up as time goes on until eventually you've paid the loan off. All of that money, going back to the math of this, is not in your favor if you're renting, right? So, and I'm about to ask you, I'll set you up for the question just to give you a second to think about it. I'm going to ask you roughly what it costs to refi a $500,000 loan. So right now, if you think about it, if you purchase a home at 500 grand and you're at today's rates, whatever they are, and you're paying down, let's just say roughly $1,000 a month, right? But whatever it is, you're paying down $1,000 a month from your payment towards your principal. That's $10,000, $12,000 over the span of a year. Nate, tell me, if I were wanting to refi because rates dropped and now I want to take advantage of that because, oh my gosh, I made the mistake of purchasing when rates are 6, 7%, and now they dropped a quarter or a half of a point. How much is it going to cost me to refi?
A refi is going to vary a little bit, but I would say on a $500,000 property, $500,000 isn't a small amount of money. You're probably looking somewhere between $13,000 to $15,000 on the low end.
Okay, so what we're talking about is maybe 12 to 18 months of my paying down into my equity is going to cover that. So essentially, I would have broken even if I'm wrong, right? And I would have gotten it at a cheaper price because now if rates came down, remember we talked about prices have gone up. And for 12 to 18 months, I was in my house doing what I wanted, painting it neon purple or whatever crazy colors I like to paint it, putting my shelves up with holes in the wall, and I didn't have to ask a landlord. And that's in the worst case scenario. That's assuming that you buy and rates come down, which is what most people's fears are, right? So essentially you broke even roughly on what you had built in for equity throughout the year and a half by paying for that refi, but now you get the same rate you would have, and you got it at a cheaper price. So really, when you do the math, guys, there's so many emotions that go with this. I get it. I feel for people. And this is why I really push people to get with a good, intelligent lender, intelligent realtor who can go over these numbers with you to show you that sometimes your emotions make sense and you should be fearful and you shouldn't buy or you shouldn't sell, whatever it is. But sometimes they're not, right? Sometimes you need to look at the math. And this is going to bring me to the second question I've got here, Nate. Same question, but I want to put myself in a situation that I'm in. You've got a, let's say, 2.5% interest rate owner, and they own a home worth 400 grand. They want to get into a home that's 650, so it's a step up. Maybe they want the square footage. Maybe they want to be in a nicer neighborhood, whatever it is. And now I'm saying, Nate, that next mortgage is going to run me 6, 7%. I'm currently at 2.5. Does it make sense for me to sell and then buy? What are you telling that person?
I'm telling that person that I think that it makes a ton of sense, and here's how we're going to get there. You probably have some debt that you have taken on, whether it's a car, credit cards, I don't know what it is. But
we got a frozen Nate. You guys ever seen a frozen Nate before? You're looking at him right now. Let's see if he comes back on. Man, I know what he was about to do, and it was going to be cool.
Can you hear me?
I can hear you now. Okay. So last we heard, you probably have some credit card debt that you'd taken on.
Or a car or something, right?
Yep.
The idea is to keep your payments as close as you can. So if right now I've got $1,300 in debt and a $3,000 mortgage payment. And now I'm looking at going into a mortgage payment that's going to take me up to maybe $4,500, but I've eliminated all of that debt. It's a net wash for me, right? I've paid off those debts. I don't have those debts anymore. I've basically taken the equity that I had. I've paid it all down. Yes, my mortgage payment went up. That's fine. I'm still putting money into the other pocket, and I'm still getting appreciation in that house. So if I wait another couple of years, I've still got equity in that house. I didn't put myself in a worst case situation by taking that debt with me. I did the smart thing by paying it off. So my payments monthly haven't changed.
That's a phenomenal example of how it would make mathematical sense to fulfill your emotional desires to move up even when the rate gets higher. I'll say this, guys. If you were to call me and ask me that question, I'd say, I don't know. Let me ask you a few questions. Let's delve into your motivation. How big is your motivation? Again, if you're getting a divorce, it probably is better to take on a higher rate and get the heck out of those negative feelings, but not always. What kind of financial situation are you in? Are you going to go broke or bankrupt if you do that? Do you have kids involved? Maybe it's not a must. Maybe it's just we'd like to be in that neighborhood and we don't have any debt. Okay, well, then maybe it makes sense to stay, right? My overarching recommendation here, though, would be run the numbers. Again, don't just look at whatever frustrates you or gets your emotions going and then chalk it up to, I don't like that thing, I'm not going to do it. Really take the time to run the numbers. Either way, it might not make sense to buy and it might make sense and you're not doing it. But if you look at the numbers with a professional who can explain them to you, man, the worst thing that's going to happen is you're going to do the thing you were going to do anyway. But now you've got the confidence and the education to back it up so you feel more confident about it, right?
Yeah.
So,
yeah.
Nate, any final thoughts on this?
No, just if you guys have any questions about anything I touched on or you want me to explain anything better, reach out to us. Joe is one of the best real estate agents that I've had the pleasure of working alongside. He can answer all your real estate questions. I'm happy to spend as much time with you as you need to crunch some numbers and make the mortgage payment that you're going to take on or that you currently have make sense for you. I don't consider myself to be a mortgage broker. I consider myself to be an advisor, somebody that educates. So if you have questions, I want to answer them.
Well, thank you, Nate. I appreciate it. Everybody's wondering this one question, what's the answer? And I think you enlightened us. So thank you. Guys, if you've got any questions, comments, whatever it is, you can put it in even after the video, and either I or Nate will get back to you with a response. Thank you, as always, for joining us, and have an absolutely wonderful weekend. Thank you, Nate.
Awesome. Thank you.